Welcome to the module on Financial Markets, Money Markets, and Institutions. Learning Objectives. Understand the concept of financial intermediary. Appreciate the role played by financial intermediary in financial markets. Identify main objectives of financial markets. Classify financial markets according to the maturity of traded instruments. Classify secondary markets according to the nature of trading. Let us first understand certain terminologies. Financial intermediary. A financial intermediary is an institution which brings together providers and users of finance. They link lenders with borrowers by obtaining deposits from lenders and then re-lending them to borrowers. In a financial market, the individuals and organizations with surplus funds lend funds to other individuals and organizations that want to borrow. There are multiple ways funds are routed from lender savers to borrower spenders. The first route is the direct finance route, that is, at the bottom of the diagram. The borrowers borrow funds directly from the lenders in the financial markets by selling them the securities. Securities are claims on the borrower's future income or assets. This transmission of funds from savers to spenders is a crucial function for the economy. Without financial markets, it is hard to transfer funds from lender savers to borrower spenders. Lender saver with surplus funds will have no investment opportunities, and borrower spenders with investment opportunities will have no funds to operate. Thus, both would be worse off as a result. Hence, financial markets are essential to promoting economic efficiency. Financial markets can be classified as capital and money markets. Capital markets for medium-term and long-term capital. Money markets are markets for short-term capital. Primary and secondary markets. Exchange-traded and over-the-counter markets. Money markets. Money markets are for trading in short-term financial instruments, and also for short-term lending and borrowing. Therefore, the money markets are operated by the banks and other financial institutions. The period of the financial instruments is measured by maturity of the instrument. Maturity means the time when the financial instrument reaches its settlement date. Capital markets. Capital markets are markets for trading in long-term finance, in the form of long-term financial instruments such as equities and corporate bonds, or loan notes. A stock market is a primary market for raising finance, and as a secondary market for the trading of existing securities. Securities are tradable financial instruments, either in the form of equity, or debt, or derivatives. In capital markets, organizations obtain long-term or medium-term capital in one of the following ways. They raise their share capital by issuing ordinary share capital to investors to take an equity stake in the business, or to increase their existing equity stake. They may raise debt capital in the form of debentures, corporate bonds, loan notes, or convertible bonds. Primary and secondary markets are also part of capital markets. Primary markets enable organizations to raise new finance. Secondary markets enable investors to buy and sell existing investments amongst the participants. Exchange-traded instruments and over-the-counter markets. Secondary markets may be organized on exchanges, or may consist of over-the-counter, that is, OTC, transactions. Secondary markets for financial securities can be organized on exchanges. Here buyers and sellers of securities buy and sell in one location, that is, the exchange. Examples of exchanges include the Bombay Stock Exchange, London Stock Exchange, and the New York Stock Exchange for the trading of shares. The Chicago Board of Trade for the trading of commodities and derivatives, and the London International Financial Futures and Options Exchange, that is, LIFFE, is a secondary market for trading of derivatives. Alternatively, secondary markets can operate as over-the-counter, that is, OTC, markets, where transactions do not involve buying and selling through an exchange, but customers negotiate individual transactions, usually with a financial intermediary such as a bank. Securities that are issued in an over-the-counter market can be negotiable or non-negotiable. Negotiable securities can be resold, whereas non-negotiable securities cannot be resold. In this video, we understood the important role played by financial intermediary in financial markets. We found multiple ways in which funds are routed from lender savers to borrower-spenders, and role played by financial markets in this process. We understood the importance of maturity of traded instruments, and the nature of trading and classification of markets.